Hi, I'm Keith Weiner, founder and CEO of Monetary Metals. Today I want to talk about the idea of a market and interest rates, and we don't have a free market today in dollar interest rate. Let me explain what I mean by that. So imagine if you go to the grocery store, you want to buy some food, and you walk in the front door and the grocery store says, we're going to take your money. You're going to pay $129 whether you buy any meat or not, because that's just how it's going to work from now on. So what would you expect as you go to the back of the store and you go to the meat section and you see the prices for the various meats? You'd probably expect to find chicken, the cheapest meat, $129 a pound, because that's how much money they just took from you. Pork at $149, tenderloin at $199, and filet mignon is probably $299. They've already got you. There's a pretense, there's a facade of being a market. But of course, it isn't really a market if you have to pay when you walk in, whether you take any product home or not. That's basically what they've done in the dollar. They said, you're going to be a lender, whether you have a paper dollar bill in your wallet, or whether you just go to your bank and log in and you see the digits on the screen, they've got you. The paper dollar bill, you don't have money in your wallet if you have a dollar bill. You have a Federal Reserve note. And what does note mean? It means promissory note. You have extended credit to the Fed, which the Fed, of course, in turn extends to the US government. Or you can deposit that dollar in a bank, in which case you're lending it to the bank. The bank is going to lend it to the Fed or lend it to the Treasury. But no matter what, you are a lender, you are a creditor, you are giving your savings over to somebody else, whether you realize it or not, whether you want it or not. And so you have been disenfranchised. They've taken away the fundamental choice to lend or not lend. On top of that, if you hold dollars, you're probably aware, if you're interested in gold, if you hold dollars, you own something that the Fed promises to achieve a mission of what they call price stability. I think Orwell would be pretty proud looking down on how they've defined price stability as the dollar is losing 2% of its value every year. The dollar is going down. And so that, of course, gives additional incentive for you to find something to lend to that earns an interest rate above 2%, because cash is always eroding, it's always going away. So in gold, both of these factors do not exist. Number one, gold isn't going down. Nobody has the power to debase gold, obviously. And number two, there's an actual choice. You have the right, if you choose to put the gold in your pocket or bury it under the mattress if you choose. Or now with monetary metals, you have the right to bring it in and put it into the market and earn an interest rate based on your preferences. But there's a real choice. You can always take your gold and go home and not play. That choice is what allows us to make the statement that this is the first, to the best of my knowledge, best of our knowledge, this is the first actual free market setting an interest rate since the Fed was created. They passed the Federal Reserve Act the end of 1913. The Fed begins operating in 1914. Pretty shortly thereafter, it begins buying government bonds, which means it begins to alter and distort the interest rate. And as soon as they do that, there's no longer really a free market. There's just the packaging, just the wrapping of a market. But in operations, it really isn't a free market anymore. And now, for the first time in 104 years, there is. So we're pretty excited about it. Thank you for following our progress. Thank you for your interest.